Hey, welcome back. My guest in this segment, returning for the, 10th time, is Charles Taerk, President and CEO of the Ninepoint Alternative Health Fund. Charles, welcome back.
Thanks very much for having me.
Charles, the market has been revalued to the downside since you were here last, mostly starting post-October 17th, which one would have thought would have been a day where the angels would be bugling from on high. This is not the case. What happened?
Well, I think if people look at what's gone on the last 2 years, people have sold on the news. And so there was a great rise from the middle of August when Constellation invested in Canopy. Great run for 2 months until the 17th of October. I think the combination of people being disappointed with rec and some of the earnings concerns, and people have been selling off. In addition, we've seen a global equity market sell-off. You have the Dow, the S&P, the TSX, oil prices. Nothing was spared during the month of October.
Sure. Would you say that the tendency in the last 2 weeks that we've observed is that the large cap cannabis index, as we track it, which is all companies over 500 million trading in Canada, the action in that index is starting to very closely mimic the S&P 500.
Yeah, very much so.
And is that an expectation that we should carry forward going into the future where...
Well, no, but I think what it shows you is that the sell-off is more than just the cannabis sector. When you start to get macroeconomic factors taking a big swipe out of the equity market, no sector is being spared.
Right.
But if you look at the volatility and you take a look at the dramatic decline in some of the cannabis names relative to the broader market, there's been more of a deficit, let's say, in the larger cannabis names than in the broader market.
To what extent would you say the earnings that have been reported by at least almost 20 companies in the last 2 weeks, how much has that had an effect on the downdraft in the cannabis space particularly?
Well, it should. I think it is having some effect. And this is something, as an active manager in the space, we have been taking a look while the sector was doing really well, and we were paring back. We were taking profits in September and early October. Our view was that there was going to be some type of give back, not as much as we've seen, but we were taking profits in anticipation of that. I think the market was anticipating better revenue and earnings with an expectation that some of that revenue was going to be from the domestic recreational rollout. And what we've now seen is that for the September 30th quarter end, very little revenue was earned because most of the sales went in beginning of October. So there was an expectation of something that didn't materialize. And then you look at bottom line results of just the medical business with many of the large players really disappointing, and really disappointing on two key metrics. Some of the larger players had significant general and administrative expense balloons. So that's not operational, that's everything that has nothing to do with the cultivation side of the business. So it's marketing and advertising and other non-core operations. And there's some significant disappointment. Looking to 2019, I think earnings is going to become a more important issue. People should be paying attention to the EBITDA, the EBITDA force of these companies. They should be improving their earnings because a lot of the build out is now behind them. So we should see better profitability. And if we don't, again, companies are going to suffer. You're going to ask me, so which companies, right? Go ahead.
Well, are there any companies that disappointed particularly and any that surprised to the upside particularly?
Yeah, I mean, both Canopy and Aurora, I think, were significantly disappointing for the broader market. We don't hold Aurora at the moment. We actually took profits in Canopy during September and early October, and so our weighting in Canopy is greatly reduced. It used to be a top 10 position. By the end of October, it was no longer a top 10 position. But both had similar quarterly results where G&A expenses were much higher than consensus estimates, magnitudes of adjustment. Like we're talking 50, 60, $70 million in losses caused largely by huge G&A expenses.
Right.
Whereas conversely, you see a company like CannTrust, last week was a really busy week. There were about 5 or 6 companies that came out with earnings, and 4 of them were disappointing. CannTrust came out with their earnings for the quarter where they had higher revenue than expected. They had better revenue per gram than expected. They continue to gain more new patients into the medical industry than any other licensed producer, and more revenue from extracts relative to dried bud, which is higher value added revenue. So they're firing on all cylinders. They were the only company to generate positive EBITDA in the quarter. And that's important, at least for us as portfolio managers. I think retail investors aren't paying enough attention to some of the nitty-gritty, and that's where I think we have an opportunity to outperform, where regardless of the valuation of some of these companies or the size, you've got to be looking at some valuation metrics that we believe are going to be meaningful going forward.
Sure. What about Trulieve? Trulieve reported $100 million in run rate revenue for the year.
Yeah, so Trulieve is doing very, very well. This is a Florida medical dispensary business. About 6 months ago, the interesting change with Trulieve is they had about 70% of the Florida market, so really significant control. Of late, you're seeing new entrants into Florida, Curaleaf being one of them. Liberty Health is also expanding its footprint, and so they're nipping away at Trulieve's leadership. By the end of the quarter, Trulieve was now down to about 55%. I mean, still commanding performance, but you're starting to see more competition in Florida. So it'll be interesting to see how Trulieve is able to move forward, kind of keeping that control.
Do you think that the somewhat let's call it less than perfect best case scenario rollout of government cannabis distribution in Canada was to blame in part for the dismal earnings in the last, as reported by these companies? Even though it was only 2 weeks of October, I would have thought that if they could have sold everything that was ordered, so that everybody could have put that on their balance sheet, it might have been a different story.
Well, remember, the earnings release were from September 30th. So
right,
there was only about a week of revenue impact. And so what each of them have done is they've said out of their quarterly revenue, this was the amount that was allocated toward domestic rec. So
they didn't pre-sell any quantities to
the expectation from investors was, well, given that October 17 is the day when the stores open, we would expect that 45 days before, the provinces are going to have the logistics going such that they're going to have inventory such that there would be sales slips coming somewhere, and that didn't happen.
Okay, so that's what I'm getting at.
So
is
now,
that the fault?
So, well, that's part of it, but I think that was an expectation. I think the other part of it is ramp up in some of the production facilities is maybe more gradual than others have anticipated. You're seeing lower revenue per gram with some people, and that could be a sense of quality, whether you're an outdoor grower or an indoor grower. And then where your focus has been. If you're focused on the medical market and you're gaining patients, then your revenues, I think, are going to be stabilized by the lack of recreational rollout. Whereas if you're putting more of your resources into the rec market and you've got these disappointing logistical challenges still present, and I think that's going to take months to unravel, then you're going to see maybe some weakness or disappointment in the next quarter as well.
Right. Some of the money managers I talk to have been reducing their exposure to Canadian LPs in favor of U.S. ones because the perception is that the Canadian market is now more or less saturated and the U.S. market still is representative of opportunity, especially ahead of any federal deprohibition that might be coming down the pike. So is that something that you're doing in the health care
Sure.
fund?
So the Canadian companies, I think from an addressable market standpoint, the domestic recreational and medical market is only about $1 billion in Canada, whereas in the US, currently it's estimated around $15 billion. Because of the challenges that the US companies have to become public companies, they're coming to Canada through RTOs on the CSE. Many of them don't get treated with the same multi-billion-dollar valuations that the large Canadian companies have that have listed on NASDAQ. So from a valuation mismatch standpoint, yeah, the US companies are undervalued. They're trading similar to the junior Canadian companies. Those Canadian companies that trade under $1 billion are trading somewhere between 12 times 2020 earnings and less. And that's where the US companies are. And yet the US companies have very large addressable markets, have historical revenue and historical earnings, and are very well capitalized. So yeah, it's something that people should be paying attention to.
So, but the UIT fund, is it still predominantly focused on Canadian names?
Nope, we look everywhere.
Okay.
Yep.
Okay, so great. So tell me, how is the fund doing year to date at this point?
Great. No, it's relative to the market, we're
Right.
doing well. We've given back a little bit, but year to date, our fund is up 27%. And that's really important because when people look at the sector, there's usually a couple of ways to look at it. Either you want to buy an index or you want to buy an actively managed product. We believe that our actively managed approach lowers volatility and puts people in a better position. So year to date to yesterday, excuse me, we're up 27%. The passive strategy, the ETF, is down 2%. So that's a wide difference. And really what we're demonstrating is being active, taking profits at the right time. It's not that we don't like the name, but the valuation just doesn't warrant our attention. We've got to move into other areas where other people aren't. And so having a wider portfolio allocation, occasionally owning some private companies, which we take advantage of, so we can own them earlier than when they get accepted into the index. Those are all different elements that we use in our fund.
Okay. Charles, that's great. We're going to leave it there. Thank you very much for your participation again.
Terrific. Thanks for having me on.